So guys, in this video, I'm going to be breaking down where I see the opportunities within the markets. Am I going to be buying Apple? Am I going to be buying Tesla? Or is there something else out there that holds better value, that is ripe and ready for the taking going into 2024? Here's my analysis and here's my breakdown of exactly how I see the markets panning out in 2024. What are institutions focused on going into 2024? Hang around and you'll find out. Before we look into Tesla and we look into Apple and even Amazon as opportunities within the market, we need to understand one key thing. It's called PE ratio, profits to earnings ratio. This is a metric that we can use to understand whether or not a stock is undervalued, at the right price, or overvalued. So I want to break that down for you. So let's work out exactly how do we calculate PE ratio so you have an understanding of what is cheap and what is expensive from a stock perspective. So we have PE ratio. So there's two parts to this. First of all, we have price. So price of a share. So let's say that our share is worth $100. Now we have the second part, which is earnings. So let's say that the company is making us $10 per share that we hold. So to work out what PE ratio is, we simply take the $100 from our share price, we divide it by 10, which is our earnings per share, and then we get 10, which is the PE ratio. So when we look at this, we've got different types of PE ratios. We've got a low PE ratio, which means that the stock is classed as cheap. We've then got what we call our average PE ratio, which is the normal trading price for a share. And then we've also got our expensive. Now on the expensive side is something that we probably want to stay away from. It means that the stock is trading at a multiple that is well above its average and not something that we necessarily want to invest in. These stocks are usually hyped up and there's a lot of media attention around those stocks, for example. So a low PE ratio would be 5. An average PE ratio would be say 15 to 16, and a high PE ratio would be anything that's sort of 20, 22 plus. So this gives you a better understanding of how PE ratio works. Now let's break down those shares. So let's break down Tesla. Tesla price at this moment in time is at around $200. You can see on the chart on the screen at this moment in time. Now, $200, is this going to be an area to bounce? Now, a lot of people really love Tesla as a share price, but is it good value? And is this the right level to buy it? So if we now look at this chart here, you can see that the PE ratio that we're looking at of Tesla is 59 times. Now, when we just spoke about the averages of the market, you can see that this is well above the average. Now, that is often actually remains true for Tesla because there is a lot of hype around Tesla and there has also been a lot of growth. But from a core fundamental aspect, this shows that actually the PE ratio is extremely high and it's something that we should be cautious of. So let's have a look at the company a little bit further. So when we break down Tesla in comparison to its peers, you can see the difference in the PE ratio ranging from Ferrari all the way down to General Motors. You can see exactly how high Tesla is trading on a multiple, and this is something to be cautious of. I mean, General Motors is literally trading at 3.9 times. So there could be the argument here that there's a better opportunity within that share price over Tesla. On this chart, you can see the average of the sector, and you can see that Tesla is well into that red dial at the far end, away from the fair average, and that's something that we want to be cautious of. So now when we look at, based off the fundamental analysis of Tesla, and we look at how much is this company making, and we break down this based off of fair value, you can see actually that Tesla is around the right price based off of how it's performing. So that means that at this moment in time that the share price is mimicking the fundamental analysis, which means that there isn't that much upside, theoretically speaking, based off of the current fundamentals. So again, this is something that shows as a red flag for us because we ultimately want to be buying stocks that are undervalued. So at this moment in time for me, Tesla isn't a buy. Now let's move on to Apple and break down Apple. So let's have a look at Apple. So we can see here on the chart that the share price is currently at $170. So now we want to have a look at the PE ratio. We want to get a better understanding of how it's trading based off its fundamental analysis. So now when we look at the PE ratio, we can see that this PE ratio is a lot better than Tesla. It's at 28.2. Now we need to know roughly in comparison to the sector, is this high or is this low? In comparison to a market average, it is still high, but this is Apple after all, and it is trading at a higher multiple. So now when we compare Apple against its peers such as Netflix, Microsoft, so on and so forth, you can actually see that Apple is not the most expensive in comparison to its peers. This puts it in a good light, and it also shows that it may be trading at slightly less of a multiple than the peer average, which means that we could ultimately see Apple's share price move higher based off of the fact that its PE ratio is trading slightly lower than its competitors. And this is reiterated here on the chart, where you can see where Apple's current PE ratio is in comparison to the average. So you can see that it's actually in the green again, which is a fantastic thing for Apple. We all know that Apple is a mega stock, and ultimately there is more upside in Apple, but it's more reassuring to see it trading at below the average from a PE ratio perspective. So now we're going to have a look at the share price, whether or not it's currently trading at the right price, below, as in we could buy this stock at discount, or whether or not it's trading above the true price of what we should be looking at from a fair value calculation perspective. So when we look at this, Apple's actually trading slightly above what it should be. It's trading at $170, and it should be trading at $160 if you was to be buying this at the optimal fair price. So now we've reviewed Tesla and Apple. You can see where the opportunities are and where they aren't based off of the fundamental aspect. But let's look and explore further opportunities of where they are trading at discount, and more importantly, how the institutions have already highlighted this. We can see on this chart here different comparisons of 2023 total returns based off of the S&P. So you can see the S&P 50 there with a 20% yield performing at top there in light blue, which is very interesting. And then secondly, you've got the S&P 100, which is about 14%. And then thirdly, you've got the S&P 500, which is around 8.5%. So that's the S&P 500. Then you've got S&P equal weight, which is around -4%. And then you've got the S&P small cap, which is -6%. So now we can see the breakdown between different performances on year to date from the S&P. And this is very, very interesting. You can see small caps is at the bottom. And this is where my focus and attention is going to lie, because institutional research has shown us some interesting facts about how the S&P small cap is performing and where the potential opportunity sits. So now we're going to explore our next chart, which is our forward PE ratios of the S&P. And we can see some interesting information on this chart that we could take advantage of. You can see the difference here between large cap, mid cap and small cap performance from a forward looking PE ratio. And you can see, guess what? Which one is currently at the bottom? You're right, it's small caps. Now the PE ratio of the small cap market is currently at 11.3. So now we want to explore, what is this in comparison to the average? And how does this scale up with an opportunity? You can see, currently speaking, that the small cap has the smallest PE ratio, which means that the stocks within this are the cheapest at this moment in time. Now we want to explore this a little bit further, because we know that when a recession happens, small caps are the ones that get hit the hardest. And in sometimes over 40% of companies within that index are profitable during recessions. So now we're looking at a different chart. We've got large cap at the top, we've got mid cap, and then we've got small cap. Can you see on the chart here, especially on the large cap, how the forward PE ratio is still relatively high in comparison to the one all the way at the bottom of small caps? So when we take this away, it means that the small cap has a much lower forward PE ratio than the large cap. And that's something that we want to take note of, to highlight, to see if there is an opportunity from this that we can take advantage of. For those that are wondering as well, those areas that are highlighted in pink, those are recession zones, or where we've had a downturn in the economy. So we can see the PE ratio currently on the large cap is 17.4. So what does that actually mean? In fact, it's actually undervalued from the average. If we look over the last 15 years of data from the S&P 500, the average PE ratio is 19.4. So if the average is 19.4, the S&P 500 is quite clearly actually trading below that, even from a large cap perspective. But let's now have a look at the extreme of looking at small cap and see if there's a difference in that figure. So as you can see on the chart, the S&P small cap is currently trading at 11.5 times PE ratio. Let's now look at the average for that. Let's have a look at what the 10-year and 20-year average is for that index. It's 20.8 and 19.6 on a 10-year and 20-year average. So you can see there that the average difference between what the 10 and 20 year is on the small cap from where we currently are at is much greater than the large cap, which means that there is a much larger multiple of opportunity within that small cap area. JP Morgan says that forward-looking performance coming out of these periods is quite compelling. In the 10 years following the tech bubble, small caps outperformed large 8 out of 10 times, and by over 400 basis points per year on average. In addition to these attractive valuations, small caps have done well in periods of rising rates and high but declining inflation. However, as monetary conditions remain tight and the Federal Reserve attempts to glide the US economy to a soft landing. In addition to these attractive valuations, small caps have done well in periods of rising rates and high but declining inflation. So in this exact scenario, we're actually experiencing this right now. Inflation is starting to drop. And this is what JP Morgan is exactly saying of where the opportunity lies. So we want to take advantage of this as much as possible. Small cap index valuations are at their lowest value in over 20 years in comparison to the large caps. Now this just highlights, again, what everybody's saying, what JP Morgan is saying, what Bloomberg data is saying. This shows us that the opportunity here is 100% within the small caps, especially based off the analysis that inflation is going to start dropping going into 2024 and that we're looking at a soft landing in the US. You can see how much value, just based off of this chart, there is within this opportunity. So here we're looking at the S&P 600. You can see that it's down nearly 10% year to date. Even if the market was to rally back to the previous highs of this year, we're looking at over a 20% gain if we was to buy an S&P 600 ETF. Small caps have outperformed large cap 8 out of 10 times based off of history. So ultimately, where can you buy this? This is here. You can see the S&P iShares 600 ETF. This is where you can buy into the S&P 600 from an ETF perspective, from a diversification perspective, and ultimately take all of that institutional research that we've just discussed with yourselves and take advantage of this potential move going into 2024. So guys, I hope you've enjoyed this research behind it. I know it was a lot of charts, but hopefully you can take away this awesome opportunity from the research. And if you want to see more like this, then get in the comments, let me know what you want to see, and ultimately hit that like and subscribe button if you want to see more of my content.